Hi, how are you? My name is Rick Suarez. I'm the creator of the Nutty Real Estate Professor. And today's lesson is going to be about straight line depreciation. Let's get into it. All right, so straight line depreciation, first I want to explain, then we're going to go through some math problems. First of all, what do you need to know? Well, this is an IRS issue, right? This is a deduction that IRS lets you do on an investment property. So if your investment property is a residential property, you get to depreciate it for 27.5. Is your investment property non-residential, which is how IRS sees it, is 39.0. Now, what is residential? Residential is a property that someone lives there permanently, meaning if it's 5 units or 10 units or 20 units, where in the real estate side, we consider that commercial, IRS sees that as residential. If people are living there, residential. Simple as that. So you got to keep that in mind when you're doing your math problem. Couple things you also need to know: land cannot be depreciated. Why? Because it's indestructible. You burn down the building, the land still stands. So you cannot depreciate the land. So most times you're going to have to take away the land, right? The land portion from the math problem. And the investor cannot live in the property. You just can't live there. Right? Cannot. If you have a 20-unit apartment complex and you say, well, I'm going to live in one of the units and rent out the rest and I'll manage it and I'm going to take advantage of straight line depreciation, you can't. You can't do that. Cannot live in the property. As long as it's an investment property, you don't live there, you could take advantage of straight line depreciation. Now, how does it work? Here's an example of residential, $525,000. Now, this is just simple math. I'm not using the land or the closing costs because it gets a little bit more complicated than that. But let's just do very simple math. So this investor purchases property for $525,000. It is residential, so it's only 27.5. This means that he gets, or she, gets a $19,090 tax credit yearly for the next 27.5. And what does that mean? It means when you go see your accountant, you already got a credit of 19,000. Does that mean you're getting 19,000 back? No, it means you have a credit. So if you were supposed to pay on another issue, because this is just one part of your tax return, let's say you need to pay on another investment, well, you have a cushion to help you not pay. You have up to $19,000. Over here in non-residential, commercial, again, if you live in the property, you cannot deduct it. You cannot use straight line depreciation. And as far as IRS is concerned, it is permanent living. They consider that residential. So hotels, motels don't count because it's not permanent living, okay? So in this example, non-residential, a commercial property is $850,000. Again, this is just simple math. 39 years, you get a tax credit of $21,794 with 87 cents. One thing I tell investors they need to consider, and that is if, let's say, you kept this property, right, for 10 years, you're going to have benefit, and I'm throwing the math off the top of my head and just add a zero just to make it simple. You have benefited $190,900 in tax credits. So you're going to sell in the 10th year. So now IRS says, okay, now it's our turn. We gave you a break for the last 10 years. We want a little bit of it back. So they take what's called a recapture fee, and that is 25% of the sale, of the amount that they gave to you. So on top of the fact that you're going to have to probably end up paying capital gains on your investment, you're now going to need to pay them back 25%. Now, that's the last number that I know. It could have changed. I don't know. I'm not an accountant. But this is called recapture. This is why some investors choose not to depreciate, although I see it as a huge benefit. Because even if you have to pay back 25%, okay, it's $47,000, but you enjoyed $190,000. So if it's worth it to you, do it. If it's not worth it to you, just simply don't do it or let your investor not do it. Now let's look at some simple math. Here's one very simple. You may see it like this. Now, if you're a broker, I know that you may see it like this. If you're pre-sales, you may see it like this too. Just very simple math. But then I'm going to complicate it a little more with other math problems, and you'll see what I'm talking about. All right, so what would be the depreciation deduction allowed in the first year of owning a residential investment building worth $650,000? So first of all, they're letting us know it's residential. That's a great clue. So all we need to do is get 650 and divide by 27.5. That's all we need to do. There's really nothing else, right? There's nothing else. And that answer comes out to, oh boy, I need my pen. Give me a second. That answer comes down to $23,636 with 36 cents, right? So again, this is the amount you're allowed to depreciate the property for the next 27.5. I often get asked, well, what happens after 27.5? Well, you don't get to deduct anymore. Just that simple. Let me show it to you clean so you can appreciate it better. There it is right there. This was the sales price. And this is the year, because it's residential, is 23,636. Now it is a little bit more complex because you got to tack on the closing costs, and then you have to take out the land. And but in these math problems, you don't see it. And I know in the broker's course, it's a possibility you may get it as simple as this. All right, so in this next math problem, we're just going to obviously do the opposite, which we're going to use what? We're going to use commercial. So let's read the math problem. And it says here, how much is the depreciation permitted in the initial year of owning a commercial investment building? So this one is 575, and you're going to divide by 39.0. And that answer is going to be 14,743 with 50 cents. Again, what does that mean? That is a tax credit. You're allowed to reduce the property 14,743 every year for the next 39 years. Let me show it to you clean. Here it is. 575 divided by 39 years is 14,473 with 59 cents. That's it. That's the end of your math problem. Now, do note that in the answers, they'll have the residential one in case you mix this one with 27.5 or the other one with 39.0. That answer will be looking at you as well. Now, this is a little bit more of a complex problem. This is more of the style of problem that you may get. Let's go through it. It says an apartment building that consists of 200 units. I don't need this. I just need numbers, right? Sales. Units was sold for a total of $4 million. The closing costs associated with the sale amounted to $56,300. See, that was an expense. So we need to add that to the $4 million. And the land represents for 25%. So now they're giving us the land, how much the land represents. So let's take a look at this. This is $4 million. And we're going to add 56,300. So the answer is 4,056,300. That's including the closing cost, because this is the closing cost. But what must we do? Then we need to multiply this times 75%. Now, why 75%? Because they're telling us that 25% represents the land. So that means that 75 has to represent the building. Okay, that answer, and I'll put it here because it doesn't fit, it's 3,042,225, right? Now we get to divide this by how much, right? Now, what are we looking at? Is this a commercial building or is this a residential property? Well, they're telling us it's an apartment building, and an apartment building, even though it's 200 units, we're used to that. The thing is, you have to change the way you think here because this is IRS. This is not real estate, right? So you're going to divide by what? 27.5. And that answer is going to be 110,626 with 36 cents. And this is how much the investor gets to depreciate the building every single year for the next 27.5 years. Let me show it to you clean. There it is right there. Here's the $4 million of the initial purchase plus the closing cost, which is $56,300, giving you a total of $4,056,000 with $300. Then you multiply that times 75. Again, why? Because the land represents 25. We have to deduct the land. In the previous problem, they didn't tell us about the land, so we couldn't deduct anything. We're not going to make it up. So you got to read the question, make sure that you give them what they're asking for. Don't start putting in things there that are not there. So the total here is $3,042,225. You divide that by 27.5, and you end up with $110,626. And as a reminder, residential is 27.5, and non-residential is 39.0. Let's look at a different math problem. Here we have if the IRS allows for an annual depreciation allowance of $35,000 for a small shopping center. So right now, if they're talking about shopping center, it's 39.0. This has to be commercial, right? Consists of 20 stores. Again, does not factor into our math. The land represents 30%. So now we need to what? Concentrate on the 70%. But they're giving us what the depreciation is. So how do we figure it out? Well, we have to work it backwards. So what do we need to do? We have to get the 35,000, right? Because this is the yearly amount that they're getting. But they are allowed to get it for 39 years. Is that correct? So what do we have? We have 1,365,000. Now, this is not the purchase price of the building because this amount does not include what? The land. When this was done, the land was not included. So now we got to put it back. So what do we need to do? So we need to get the 1,365,000. And we're going to divide by 70% to give you a sales price of $1,950,000. So $1,950,000. That is the sales price of this building. And that concludes this math problem. Let's check it out. Let's see it much cleaner than this. And there it is right there. Here's your 35,000, which is the yearly deduction. So we got to multiply that times 39, but we don't have the building, right? So if blank times 70% equals 1,035,000, then all we need to do is divide. Anytime you have a missing component, simply divide and you'll get the answer. So 1,365,000 divided by 70% gives you 1.950. And of course, anytime you have a missing component, the idea is to simply divide. I hope I simplify straight line depreciation for you. Thank you very much. If you like my content, please like, share, and subscribe. Until next time, many blessings.